Good evening, everyone. Time for another silver update. This is the daily chart of silver provided by netdania.com. You can click on the link below. Now, I've drawn out 4 lines here. These 4 lines correspond to the crossing over of the 0 line on the MACD. You can see we had the first one in May of 2011, the next one in September of that year, and we had one in March of this year, and we're now about to get one just as we're going into the election season. So what do these crossovers mean? Let's look at the potential impact of these. The first one here, we can see that when we got this cross, we'd actually hit a price of about 34. Our ultimate low was 32. So the first cross we had actually indicated the low. In other words, when we crossed the 0 line, we were pretty much at the bottom of the move. Now, the next one is very, very different, and pardon me for not getting these lines perfect, but you can see that the cross occurred right before an enormous plunge. We're talking about the September smackdown, which is only rivaled by the original May smackdown in silver. So we're talking about a move from about $40 to $26. Big move. Next one is a cross. This is not a direct cross, a down cross like we had here. These two crosses are very sharp. You can see how the slope of ascent is very steep, whereas this cross is kind of a drifting lower cross, and we have a cross right about here, and you can see we just drifted lower. Now, the cross that we have approaching us is actually between these two, between a very violent direct down cross and kind of a sloping down cross. We're right in the middle of those two. What does that portend? I can't tell you, but if it portends something like the original crosses that we had, then we're looking at a very sharp decline, possibly even new lows in silver. I can't say. Again, this is just the paper price. The physical may vary. Your mileage may vary on that. So, but that's very important. We're going to see a resolution of this very soon as we reach that 0 point, and it's either going to cross violently to the downside, or it's going to bounce something like this bounce, or it may actually be something that we've never seen before, which is a bounce straight off the 0 line and then a rapid increase in price. So that's something we have to wait and see. Now, there's so much news to cover, so many stories, very important news stories breaking today. I don't have time to even cover them. I'm going to go into the main story, and that's going to be the German repatriation, and that's silver doctors. But before I do that, I want to look at this story from Jeff Nielsen of Bullion Bulls Canada. Now, I just can't say enough about Jeff Nielsen. I don't happen to agree with him on some politics and economics as far as the solution. But as far as his analysis of the silver and gold markets, there is really, he's top notch. I can't think of anyone better. So I'm going to read a lot of this, and then we're going to talk about the gold German story and the implications in regards to Basel III, and very, very important stories hitting the wire. So let's look at this Nielsen article. Momentous events have taken place in global markets, with both the US and the EU announcing open-ended, unlimited money printing, respectively. The exponentially increasing money printing taking place in bankrupt Western economies has escalated to simply infinite money printing. This is nothing less than a death knell for all Western fiat currencies, and our final warning that hyperinflation is now an inevitable fate. All that remains is for the currently clueless masses to realize that the paper they're carrying in their wallets is in fact nothing but paper, and then our own modern tulip mania will come to an ignominious end. So I invite you to click on all the links. You can see them highlighted, and these are very informative articles that Jeff has written in the past. Gold and silver prices naturally reacted to this monetary insanity by jumping higher, reflecting the explosion which must take place in most asset prices as our paper currencies plunged to their real value, zero. However, the rally was halted by a desperate counterattack on bullion markets, with the result being that bullion prices have now trended sideways to lower for the past several weeks. It's important for readers to understand that there is no way the newly announced money printing has been or could ever be priced into the metals markets. As the simplest of tautologies, you can never price in infinity into any market. Open-ended, unlimited money printing means nothing less than an endless spiral higher in asset prices until all this banker paper meets the same fate as all previous fiat currencies: utter worthlessness. Obviously, over the short term, asset prices have not been allowed to move higher. The mechanisms for this manipulation are now well known to sophisticated investors, while manipulative automated trading algorithms allow the banksters to lead market sheep around like the Pied Piper. The banksters' massive derivatives casino literally allows the bankers gambling on our markets to dominate the markets themselves. However, as I have explained on several previous occasions, there is a huge price to pay for such manipulation. The low prices resulting from the banker manipulation in their derivatives casino must lead to the destruction of inventories, with the long-term result being even higher prices than if no manipulation had taken place in the market at all. This naturally leads inquisitive readers to ask the obvious question: as inventories collapse, how, when will a default occur in the bullion markets? Here we must make a broad distinction between the gold and silver markets. In the gold market, gold's status as the world's best money has resulted in near perfect conservation of this metal. Put another way, it is at least theoretically possible for nearly every ounce of gold ever refined to be collected into a single stockpile. On a practical basis, most of the world's gold is contained in precious cultural artifacts and or heirloom jewelry, and wood could never come out onto the market at any price. However, there can be no question that large stockpiles of gold do exist that could come onto the market. The situation is entirely opposite with the silver markets. Nearly half a century of concerted manipulation of this market has resulted in most of the world's silver literally being consumed. It has been used in a plethora of industrial products, generally in tiny amounts, and most that silver is now scattered around the world's landfills in microscopic concentrations. Understand that it was the underpricing of silver, i.e. manipulation of the silver market, which has resulted in the destruction of inventories. Had silver been priced at a fair market value, most of this industrial consumed silver would have been recycled. We know this because only a dramatic increase in recycling could lead to equilibrium in the silver market, and by definition, a quote fair market value for any good is the price which results in market equilibrium. Thus, the destruction of silver inventories by itself is conclusive evidence of the manipulation of the silver market, since the magnitude of that destruction can lead to no other possible conclusion. Between 1990 and 2005 alone, global silver inventories plummeted by approximately 90% over the past half-century. Noted silver expert Ted Butler estimates that global stockpiles of silver plunged from approximately 6 billion ounces to somewhere around 1 billion ounces. What has been the consequence of this inventory destruction? The price of silver has moved from a 600-year low in real dollars reached in the late 1990s of under $4 an ounce to well over $30 an ounce today, a nearly tenfold increase. That multiple was significantly higher when the silver market reached its short-term peak of nearly $50 in 2011. Of course, you know the story there. The conspirators smacked it down with a triple witching May scam. You know all about the May smackdown. Meanwhile, we no longer have access to reliable inventory numbers in the silver market. Since 2005, inventory numbers have been falsified through a clumsy record-keeping sham, so we have no idea precisely how much silver remains. We do know that inventories continue to plummet as each year hundreds of millions of more ounces of silver are used/consumed than are mined out of the ground. We also have anecdotal evidence strongly suggesting that silver inventories are already stretched to the breaking point. Outspoken silver bull Eric Sprott has revealed that silver he has purchased for his Sprott Physical Silver Trust wasn't even refined until after he had purchased it and waited many weeks to take delivery. Seemingly, a bullion default in the silver market would/will be a very straightforward event. Someday soon, perhaps tomorrow, we will have an old-fashioned failure to deliver. Some large buyer of physical bullion will buy and pay for his order, and even after the bankster stalling, the bullion banks will not be able to scrounge up enough newly refined bars to meet that demand. However, in our fraudulent/convoluted markets, things are rarely as simple as they appear to be. And this is certainly true with the especially flagrant manipulation of gold and silver markets. The complexity of the dynamics becomes more apparent when we examine the gold market, where the existence of large stockpiles make a formal failure to deliver a much more unlikely event. If a gold default would not occur from an official failure to deliver, what other default-like event could occur as these fraudulent markets finally inevitably rupture? To answer that question requires taking a closer look at the real physical bullion market versus the fantasy world of the bankster's paper bullion market. We begin with the revelation of outspoken bullion basher and head of the CPM group, ex-Goldman Sachs. Now remember that Jeffrey Christian is ex-Goldman Sachs. I want you to remember that. This is very important. In testifying before the CFTC, Christian blurted out what had previously been kept secret by bullion banks. Total leverage in the bullion market is somewhere above 100 to 1. In other words, the total size of the bullion market exceeds the amount of actual bullion being traded in these markets by a factor of 100. Here, it's important that readers have a more precise understanding of the nature of that leverage. It is not direct leverage. That is, it's not a simple case of bankers leveraging bullion positions in the paper futures market by 100 to 1. Rather, the vast majority of this leverage exists in the previously mentioned derivatives casino, where manipulative bullion banks have permanent, gigantic, and ever-growing bets that bullion prices will decline, much like the banksters have used their gigantic multi-trillion-dollar bets in credit default swaps to manipulate European debt markets and bankrupt Europe's governments. The banksters have done much the same in the bullion markets with their derivative bets. There is, however, one enormous difference between the 100% paper debt markets and bullion markets. The bullion markets require physical bullion to settle all trades, where buyers insist on taking delivery, and as previously mentioned, the long-term consequence of underpricing bullion is the collapse to zero of bullion inventories. If large gold stockpiles mean that a formal default in bullion trading could likely be forestalled for a considerable period of time, what other default like event could detonate the banker's fraudulent 100-to-1 leverage. In a word, decoupling. In part 2, I'll explain this concept in detail and analyze the dynamics which could lead to this event. So, fantastic, fantastic explanation. I encourage you to click on all the links in this. It goes into other Jeff Nielsen articles. He is spot on. He understands this. He explains it. He's one of the guys that has his finger on the pulse of this game. So let's get to that huge breaking story. I'm going to go to the Silver Doctors link. That is the story today that broke that Germany is going to repatriate and audit 150 tons of gold reserves from the New York Fed. This is a huge story. Let's read this. In perhaps the biggest story of gold since Hugo Chavez sent shockwaves throughout the gold market in mid-2011 and propelled gold up $300 to a record 1915, the German Federal Accountability Office has ruled that the Bundesbank must conduct an audit on German central bank gold holdings. In anticipation has begun the repatriation of German gold from the New York Fed. The Bundesbank will request the New York Fed ship 50 tons of German gold back to the motherland a year for the next 3 years. It appears the Germans are about to receive a crash course in the lesson. He who owns the gold makes the rules, aka possession is 999 of 1,000ths of the law. Assuming the New York Fed does decide to comply with the Bundesbank's request to keep up appearances for the other central banks, we wish the cartel luck in finding 150 tons of tungsten-free fizz over the next 3 years, as the Bundesbank reportedly will physically verify the gold. So much for the cartel's plans to fill repatriation requests with tungsten-salted fizz. And this is the Der Spiegel article. Germany has the second largest gold reserves in the world, nearly 3,400 tons, supposedly anyway, because stocks have never been checked for authenticity and weight. Now, the federal court has asked the Bundesbank to examine the gold reserves abroad regularly. The German central bank gold is safely stored in vaults in Frankfurt, New York, Paris, and London. So let's think about that. Why does the German central bank, which supposedly is an independent central bank, that's the fame of the Bundesbank, is that it's the independent bank, the bank that learned the lesson of inflation under Hitler and the Weimar hyperinflation, and is the most conservative, the tightest hawk bank in the world. Why would the biggest hawk in the world store its gold in New York, Paris, and London? So that should give you pause. Continuing. Checked really, but apparently no one. The federal court has the Bundesbank now anyway required regular inspection and inventory of the vast gold reserves abroad. The auditors explain this in a report on Monday, has become known as the Budget Committee of the Bundestag, with the high value of gold holdings. The samples stored at other German bank stocks were also never by the Bundesbank itself or by other independent auditors, and it goes on. So I don't have time to read it. I encourage you to read this and follow this story. This is a huge story that's breaking. I can't even get into the implications of this story. But let's get to some of the implications with the Basel III requirements. Now, if you're not familiar with the Basel Accords and the Basel Committee on Banking Supervision and the Bank of International Settlements, the BIS, the Bank for International Settlements, is essentially the central bank of central banks. This is the bank that sets these capital requirements, and we have to understand that these capital requirements operate in 3 tiers. We have Tier 1 and Tier 2, and we actually had Tier 3 capital. They define these terms. I'll link this so you can investigate it, because I'm running out of time, but essentially they define capital in terms of safety as Tier 1, Tier 2, and Tier 3. Now, as you know, the capital requirements are changing under Basel III. That's the latest out of the BIS to regulate the banks and what they're required to keep. You have this Tier 1 capital, Tier 2 capital, and the Basel III requirements. So let's look at the changes that are potentially coming here. This is an article from Strat Risks, and you can find it from other sites. Bank of International Settlements, gold becomes a Tier 1 asset. Now, James Sinclair has covered this. It's a very important story. I'll read a little bit of this. Something is afoot in the world of high-stakes finance. The Basel Committee for Bank Supervision, the BCBS, is about to decide something crucial to bankers, sovereign nations, and gold investors alike. As part of the Bank of International Settlements, the BCBS is reviewing the upcoming new Basel III rules that may sound arcane to you, but I promise it is not. Though rarely discussed in the mainstream press, the all-important Bank of International Settlements is essentially a global central bank of the world's central banks. Its goal is ostensibly to provide global stability to the monetary and financial systems. In a surprise twist that only a few years ago would have been considered preposterous, the BCBS is entertaining whether gold should qualify as a full-fledged Tier 1 capital asset. Currently, the precious metal is relinquished to a Tier 3 status, deserving no more than 50% weighting at that, and it goes on. So I don't have time to go into the rest. I'm going to go ahead and link that. So let's look at the gold chart. Let's look at a long-term view here and think about the implications of this. Basel III is proposing that gold become a Tier 1 asset from a Tier 3 asset. In other words, gold is a unchallengeable asset. It's an asset that is the same as cash, and we know, of course, because we're stackers, it's actually better than cash. So what does that mean? That means that the banks, whether it's the central banks or the national banks of the various countries, are free and clear as long as they prove that they're holding this Tier 1 asset, if gold is in fact a Tier 1 asset. So how do you prove that you're holding a Tier 1 asset? Well, you have to hold the asset. So you have to inspect the asset. You have to prove you own the asset. And Germany now is attempting to repatriate or at least audit in 50-ton segments. So this is a huge, huge story. There's no bigger story that's broken in the last 6 months to a year. The central banks of the world are now coming under the Basel III requirements, and they're seeing the writing on the wall that their gold is going to become a Tier 1 asset, and they're going to be forced to account for their gold. The Germans are asking for their gold from America and London and France. Who's next? Who's going to ask for their gold? We know Chavez has already moved, and the Chinese have been moving for years. Of course, they're not a part of this, but again, the Western countries are a part of this, and they're going to have a giant squaring up about who owns what gold and where it's located. Of course, we know that we're looking at a gigantic three-card monte game where the central banks, probably the Federal Reserve and most likely the Bank of England and the German Central Bank, as well as others in Europe, have probably had most of their gold siphoned off to the east already. How are they going to account for this gold? We don't know. Will the Basel rules be followed? We don't know. But everything is heating up, and the point is that we're getting to the point where they're going to ask, how much physical gold do you actually own? And of course, I didn't have time to cover the story of more salted bars from the Perth Mint being counterfeited. We've had tungsten bars. Now we're seeing counterfeit bars out of China, counterfeit Perth bars out of China. And silver, of course, is the exception to this rule because silver is so cheap at this point that, again, it's not in anyone's interest to counterfeit it, especially if you're buying it directly from the mints. And so it's a very good possibility that silver will actually become a highly preferred asset, even more highly preferred than gold, simply because of the counterfeitability of silver. The fact that it's so cheap that there's no profit in counterfeiting it, while there's a high profit in counterfeiting gold. So this news is very, very important, and changes are happening rapidly. They're going to converge, in my opinion, on the election time, and we're going to see very wild moves in both the equities markets and the metals markets very, very soon. And we'll talk to you next time.